Good morning, guys. How we doing? I can
Good.
see that you're there. There's a few of you I can't see your faces, so I'm going to ask that you go ahead and bring your cameras up as we've requested. Hey, let's go through our schedule today so we know what we've got going on. In the last few minutes, I have sent to you, or to some of you rather, I've sent some WhatsApp posts concerning some schedule changes for the 27th. So a week from today. Now you'll remember that we've gone ahead and canceled the class that I was showing in the syllabus for Monday, Memorial Day. And what we've done is we're moving those presentations and the discussant sessions to a virtual structure. So the students responsible to put together those presentations will do their PowerPoints. They'll then do their presentation on via Zoom, just as they might if they were in front of a class, but there won't be any interaction, of course. And then secondly, the discussant and the presenter will have another Zoom where they go through and do some of what would have been done in the discussant role. I'll go ahead and merge those two video files and then submit them to you, but that probably won't be until Thursday the 28th. I've given them until the 27th to have those done. You'll then be responsible to view each of those, and you can expect that there will probably be some kind of an assessment coming your way to help motivate you to review them and help me see that you've done so. I'll put some dating on that when it's appropriate. So know that that's coming at us here, and that's a bit of a change. Also then, the guest speaker that we had scheduled for the 25th, Bill Kurth with Juno Financial, which is arguably likely to be the most engaging of the presenters we'll have had. Bill's got a personality about the size of Montana. And we've moved him to the 27th. So we now will have 4 concept development presentations on the 27th. Term sheets, liquidation preferences and voting rights, conversion, dilution, and ratchets, and fiduciary responsibilities and boards of directors. So all 4 of those will take place on the 27th. I've just sent out some WhatsApp posts asking for 3 of them, term sheets, liquidation preferences, and fiduciary responsibilities, to limit their presentations to about 20 minutes so that we can have all of our different pieces within our allotted 3 hours that day. Conversion, dilution, and ratchets we'll keep to 30 minutes because it can be a somewhat technical concept, and there's 2 people that have a presentation responsibility with that. So those of you that are discussants that day, I haven't sent anything out to use, but know that that's adjusting. We'll then have both Brian Knepper, who is our guest speaker already scheduled for that day. We'll have him and Bill Kurth that day. So that's going to be full, and it should be a really interesting day. So just want to make sure that you knew about some of those changes. I've updated the syllabus in Canvas. I've updated the concept development lists on the 3 concept development assignments. And those of you that are affected by this in terms of presenting and discussing and such, don't hesitate to reach out to me with questions. But I think it'll line out pretty well. So with that, Jens, you want to take just a minute and kind of give us an update as to where we should be on our accessing capital markets assignments at the moment?
Yeah, sure. Thanks, Rick. Good morning, everyone. I'll try to bring up my screen here. While I do that, Rick, can you comment on the submissions? Have all the groups submitted the first part?
You know, it's exactly what I'm looking at. So, I give me a moment and I will. Well, it looks like everyone has gone ahead and selected their company now. The one that we were waiting for was Group 2, and they've selected Flexport. So I'll update Canvas to show that in just a few minutes. And otherwise, it looks like I think everyone's got their group submission in, and I haven't rigorously assessed these, but looks good.
Okay, great. Thank you. So good job, guys, with the first part. I've seen that we have quite a few very interesting selections. So we have one group selected HipCamp, another one did Flexport. That should be really interesting. Instacart, Airbnb, and a few others. So these should be really interesting businesses to work with. So the next part, or the part of the project that you guys have to submit a report on, same type of format as the previous week, 2 to 5 pages. You can also include charts and tables and graphs in that. That is the analysis of the actual business. So you'll go deeper into the business definition. You'll have to dig into the business model and understand how it works, how the business is going to make money, what the value chain is, and also the unit economics of the product, like I tried to go through in that first lesson. Kind of evaluated like you learn in open table in terms of network effects and that kind of stuff. And then you'll look also a little bit into the management team, brand value, and risk and that sort of stuff. That's due at the end of the day next Monday, May 25th. If you have any questions, you can either ask me now, or you could just get in touch on the group, or send me a text on WhatsApp directly, or an email, and I'll get back to you as soon as I can. Do anyone have any questions right now? Rick, do you have any questions?
You know, I don't. That made sense to me, so thank you, Jens. So let's go ahead and start today. I think that our presentations are IPO market activity, and then private equity market activity, and then safes, and then direct listings. So let's go ahead and lead out with the IPO market activity.
Can I just add, Rick? I forgot to add. I need to jump off at 9:30 your time, Rick, today. So if anyone have any questions that they want to address in front of the class, do that before 9:30. Thanks.
Very good. Thank you. Okay. So I'm looking to see who's up for the IPO market activity. That's Victor, I believe that's you.
Yes, that's me. All right. Can you see my screen?
Yes.
Awesome. So I'm going to discuss today about the IPO market activity, and to look a little bit what is an IPO, and a little bit look at the history, how IPOs have gone, and also discuss a little bit about the acts that maybe have had an effect on the IPOs, and how that looks. So let's start with looking at what is an IPO. So IPO stands for Initial Public Offering. So what that means is that it's the transition from being a private company to a publicly traded company. And an IPO is looked at a little bit that it's a way to raise capital, and also it's a way for venture capital companies and angel investors to exit the company. And this is a big transition, and it requires a lot of work to get there. However, during the last, I would say, 5-8 years, it become quite a process because of some of the acts that, for instance, Jaden talked about on his presentation. So let's look at the overview of an IPO process. Well, when we start to do an IPO process, the first thing that the company needs to do is to select an underwriter. What an underwriter is, that it's an investment bank. For instance, big banks like JP Morgan, Chase, Morgan Stanley, some of these big banks that you can choose to do with. Then the second step is to do the due diligence and filings. This means you will go through the whole company, you will file the necessary files for the SEC, and then the third phase is to do the pricing. And the pricing is then just to look at the trying to get a price of the stock by doing different road shows and so forth. And then the fourth phase is stabilization, which is then to try to stabilize the stock. And then the final is five, and it's the transition, meaning that all the data that the investors are getting is market data, and they're doing their decisions by that. So let's look at the first step. Well, the first step is to select the investment bank, and the criteria commonly used to select the bank is reputation in that industry that the firm is working has an impact, because they want to look at a bank that has done some work in the space that they are going to do an IPO. Also, the quality of the underwriters' research. What kind of research they have done? Are they good at it? And also the distribution, meaning that the distribution of how this underwriting party can get financial institutions and large investors to go in with the IPO. And then also the prior relationship with the bank has an effect if they're going to go with that particular bank. We're looking at the second phase, the due diligence and filings. What happens there is there's commonly due in engagement letter. This is between the bank and the company. And this is sort of, to go through that, okay, so this is what we're going to do. This is what we like to be engaged with. And therefore, there's the underwriting agreement, meaning that they will come up with what kind of tactic they will choose to go forward. And then there will be the registration statement filed with the regulators. And then there will be the prospectus, and this just contains all of the information, the risk, the reward, valuation, in what industry it will work, and all information that is necessary. And then there's also ongoing public filings throughout the whole process. Then we're looking at pricing. So the issuing company and the underwriters, they agree on the price and shares being sold, meaning that they're coming on to an agreement that how much they want to raise capital. And IPOs, they're often underpriced. Well, the reason for that the IPOs are underpriced is that they want to attract investors, because they want to make sure that the shares that they're going to sell is going to be sold. And this will then, because if we think of it like, okay, you have 1 million shares and only 500,000 are being sold, then that means something to other investors, and that might have a negative impact on it. Then factors affecting price. Well, it's the success or failure of roadshows, companies' goals, condition of the market economy. Like for instance, now COVID-19, it's not the most attractive moment to do an IPO. And then investors should always expect a rise during the first day of trading. Well, this comes because the IPOs are often underpriced, so investors want to expect an increase in price. Then the fourth phase is the post-IPO. The underwriter provides analyst recommendation, meaning that the bank that you have done the agreement with, they will be really involved in the process also afterwards. And the underwriter can influence the price. So what this means is that if, for instance, we see that the price is going down, the underwriter might have a chance to influence it by buying more shares. But this works only for a short period of time. Like we can see here, that stabilization can only be for a short time because it requires a huge amount of capital. And then order imbalances might occur in aftermarket stabilization, meaning that there might not be that much people who want to buy or sell the stock. So this is where the underwriter can step in and stabilize the stock. So then the transition to market competition. Well, after the mandated quiet period by the SEC is over, the investors who holds the stocks who haven't sold them in the IPO phase, they're freely to trade. So they can either sell or buy more. Usually if selling and they just want to exit the company, it might seem for investors that it's not the best indicator for others, because if the company who holds a large amount of shares in the company wants to sell, it might indicate that they do not expect them to increase in value. However, it might also be that the venture capital, for instance, they have a portfolio that they needed to exit the company because of that. That also alone might be a reason for it. And then investors transition to rely on market information. Well, what this means is that they're relying on information that is provided from the firm, meaning quarterly reports, fiscal reports, and also rumors and other impacts that the economy has. So after this, then the underwriter continues to help as an advisor, meaning that they will be still involved with the company and also help them. So now we're going into the market activity. Looking a little bit at history, we can see here that the annual IPO activity since 1995 to 2019. Here we can see the amount of firms doing an IPO, and we can clearly see here the dot-com era. We can see that we're dropping in 2000 from 405 to 84. And then also further in 2007, we're dropping to 31. Well, what might be the reasons that we're doing these large drops? Well, let's talk a little bit about before 2000. Well, in 1996, there was a high of 502 IPOs, and that's quite a big amount. And this is just to say that this is only U.S. companies. And well, what this might indicate is that at that time there was a really big attraction to go to the public market because that was the best way to raise capital. Well, nowadays we have some different circumstances, so that might not be the best way to do so. However, we've seen here that we've added the Sarbanes-Oxley Act in 2002, and was that alone a factor that the IPOs decreased? Well, not really, because we can see that it only dropped from 70 to 68 and then rapidly grew from 68 to 217. And just to go quickly through the Sarbanes-Oxley Act, because we didn't really discuss it that much previously, that the SOX Act is established to help investors to get auditing and financial reports, and then this is regulations that are made for the companies. And then also the lawmakers created the legislation to protect the shareholders, employees, and the public from accounting errors. And some of the other key points that include there is that the mandated disclosure of transactions and relationships that are off balance sheet could impact the financial status. And then also establishments of fines and terms and imprisonment for tampering financial reports. And this was just to bring more the awareness of the board of directors that they are initially responsible for the financial reports what the firms are making. And this was just to sort of give the companies really some responsibility of what they're reporting to the public. And this is considered more or less a positive thing rather than a negative thing for investors and for the economy itself. Well, when we're going to 2008, we can see that there's a quite drastic drop from 213 to 31 companies doing an IPO. But then obviously it started to grow a little bit, and then we can see the influence of the Jobs Act, which Jaden did a great job on discussing with us. And just to remind what the Jobs Act was about, that it's about the emerging growth companies that are under $1 billion, that they need to disclose less information to investors. And this is then going against a little bit the Sarbanes-Oxley Act, because Sarbanes-Oxley Act was, again, to provide information. So the Jobs Act is taking a little bit that down. But however, the SOX Act is still very valid for publicly listed companies, and the Jobs Act is just for the smaller companies. And this chart here, we can see that these are the largest IPOs done in the US history to date. And we can see that Alibaba is number one, and then Visa is number two. And this is just to show you a little bit how big some of these IPOs are. And we can also see that the biggest factor here is technology. We can see that we have Uber, Slack, Facebook, Visa, and Alibaba within the technology sector. And this chart shows that the IPOs are bigger than ever before. Meanwhile, the IPO count has not increased since the 2012 Jobs Act. And this is the median last 12-month sales at IPO, and we can see reasonable growth happening there with the tech industry. That what they are doing, because what we're seeing now today are these large unicorn companies who are trying to do IPOs, and they are doing usually after they're valued $1 billion or more, because that's when they're really for them the time to do the IPO. But if we look at the last 12 months, we can clearly see that healthcare is the leading sector, meaning that healthcare industry has the most IPOs, and technology therefore only has 24. And this shows us that the healthcare industry is the one trending at the moment in IPOs, and healthcare companies do like to do an IPO rather earlier than the technology companies. So, like we discussed before, the IPOs, what are happening now, the price change we can see in these, that we can see here that the price offer, for instance, at ADC Therapeutics, the offer price is $16, and the first day close date is $20. So you can expect their reasonable growth during the first day. And also we can see that this was the Karuna Therapeutics was listed last year, and it already has returned an astonishing 426%. But what is interesting here to see is that the top four companies with the highest returns are healthcare companies. Well, what this indicates to us that the healthcare industry is really thriving in the IPO market, meaning that even though technology, like we could see before, is booming a lot, but the healthcare industry is making greater returns than technology. And then we can also see here that the US IPO returns by sector. So we can see here that healthcare is the second here with 68 companies, and they have an average return of 35.9%. And we have consumer staples at first, but only with 3 companies. So that's not really a lot of data to rely on. However, we can then see that with technology, we have 41 companies, and we have a decline of 4.6% in return, which indicates to us that healthcare is really the sector that is thriving for us. And here's some key US IPO statistics, what the average total return since 2015. And we can see here that in 2015 it was a little bit negative, but then it's positive. So the average total return is pretty good, and then the first day returns are above 10%, which means, like we discussed before, that the IPOs are underpriced, which means that the investor should always expect an increase in price before the day closes. And here we also have the Renaissance IPO index, which I haven't discussed at all. But the Renaissance IPO index is just an index of all the IPO companies. And you can also invest in an Renaissance ETF, meaning that you can invest in companies that are going to get publicly listed, and you can, through that, get all the IPO companies in your portfolio. But the interesting thing here is to see that how the Renaissance IPO index have had the returns compared to the S&P 500. And I think this is quite interesting here in 2018. We can see a negative 17.1% the Renaissance, and then the S&P 500 was only 4.4 negative. So they're moving in the same direction with positive and negative for the most part, but in 2018 the Renaissance IPO index was negative, more negative than the S&P 500 by 13%. But looking further, so what can go wrong in an IPO? I want to take the example of WeWork, and I think quite many of us have heard about WeWork. And WeWork is essentially a company that is leasing out working space for startups or for individual people, and they have a quite large portfolio. And WeWork was valued last year in February at $47 billion. And they were then trying to do an IPO starting from August, September. And the IPO then revealed that the company had huge problems. So what happened was that the valuation went first to 30 billion, then to 20. And after the filings, it went down all the way down to $8 billion. And so what the investors got out of it was that the company had revenue of 1.8 billion and losses of 1.9 billion. So the revenue wasn't even as high as the losses of the company. And also they only had cash for 5 months. So you really need to have cash in order to survive as a company, and investors didn't really see that how they can support a business that has such great losses and only cash for 5 months. So what essentially then happened is that there was no IPO, and it's considered as a catastrophe, meaning that, for instance, the CEO of the company, he needed to step down, and one of the venture capital firms took over the company and tried to do something with it. But WeWork is still struggling and trying to find a way to stir growth in a way that is going to be credible for them. And then just for the future of the IPOs, I wanted to leave this blank because the future of the IPOs now with the COVID-19, well, that's going to be a more difficult phase for the companies to raise capital, because when we think of it as that, okay, so all the companies now who have cash, where are they going to tie their cash? Well, it might be that they need to tie that cash in their existing firms. For instance, venture capital or private equity firms don't really want to invest in new companies that much. Also, private investors might not have that much cash available. So this is a really hard time, I believe, for a company to do an IPO, and it will also bring some struggles to it because of the COVID-19. So it's really hard to say that what the future for IPOs will be. And there's also big factors that why we can see that there's been sort of a decline in the IPOs because there's less cost of accessing capital. The Steve Jobs Act lets the company stay longer private. So it's a varying factor for the future of the IPOs. But yeah, this was what I wanted to say, and I'm happy to answer some questions.
Very good. Thank you. That's very interesting, Victor. Nicholas, I believe that you're our discussant, and if you'd go ahead and moderate Q&A for a few minutes and maybe offer some additional commentary. I'm also aware that you're the next presenter up, so we'll keep this to within maybe 5 or 6 minutes.
Okay. Yeah, I mean, that was a really good presentation, really informative. I liked a lot of it. One thing for the WeWork, it wasn't such a catastrophe for everybody, especially the last CEO who got out with like 1 billion worth of stock options that SoftBank was going to buy out from him.
Actually, I just read a news. Report. And
yeah,
they backed out from that.
Yeah, they're gonna buy. Yeah, but that's good. They're gonna get sued for that. That's gonna be interesting to look at. But yeah, so I had a couple of questions. These are mostly meant for Victor, but I'd like to have everybody chime in if they have some ideas. So the first one kind of goes that we've seen a large quantity of tech IPOs, or these unicorn companies, go public in the last 2 years, which haven't necessarily succeeded as well as hoped. And after WeWork's failed IPO that you mentioned, there seems to be some movement within investors that they're looking closer at the sustainability of business models for these companies and their profitability, and then kind of dialing down risk accordingly. So do you think this is going to shift the perception of going public for some of these later stage venture-backed companies and decrease the amount of IPOs in the tech sector?
Can you repeat the question? You were breaking up a little bit.
Oh, okay. So yeah, I mean, the question is just maybe is the shift in perception, or is there going to be a shift in perception of going public for these later stage venture-backed companies, and is it going to decrease the amount of IPOs in the tech sector?
Well, I mean, so for instance, what we could see last year with Uber, Lyft, WeWork, that these large companies, when they come out with because of the Jobs Act, with the limited amount of information, and this really, I think is a factor that affects investors in long term, because when we look at these companies' financials, we can see that they're repeatedly trying to access growth by any means, and that means by incurring huge amount of losses, and that also it's been backed up more from the hype of the company rather than the financials of the company. So I think the sustainability of the company to gain profit and to have enough cash flow for the company to strive is going to be the factors that investors are going to look closer into the future, because I think that sometimes I feel like that the investors forget what's the reason to invest in a company, and in this case it's to invest in growth and profit and to have a sustainable business model that really will help the company to have profit in the future, and really to have margins that support the growth of the company.
So Victor, you say that you think that investors forget why they're investing in IPOs. So yeah. I would argue from an investor standpoint, I invest to get returns. What do you think the purpose for investors investing in the IPO market is?
Well, I think that they have the same fundamentality, but however, I think that the hype is making them sometimes blind, meaning that these companies, they're so huge that they're too big to fail, meaning that they're relying that, okay, even though this company does have a negative cash flow and it's incurring huge losses, it can still get from that position to become a healthy company. So I just think that sort of that they're being blinded by the hype and the head count of users in the companies.
So would you also then say if those investors were less returns centered, certainly in the early stages, and recognized their role as helping provide liquidity for these growth engines, that we might have a more stable and healthy IPO market?
Well, yeah, and what I think that the companies that are being listed are so big already that I would believe that the investors in the public market would be more demanding if the companies would make an IPO earlier, meaning that the financials would become public earlier, so the companies would have more pressure to do a positive net income earlier.
Well, and Nicholas, that might be the perfect segue into the private market discussion, because he's now approaching on private market activity.
That is true.
I got a question real quick.
Yeah.
So I was wondering about like the timing and disclosure of financial statements in terms of an IPO. Like, when does a company have to disclose their financials? And like in terms of the WeWork example, did they ever so they were valued at 47 billion to start.
Yeah.
Did they ever IPO after, like, because I feel like if you...
No, they did not.
They did not. Okay. And they had disclosed their financials before they had IPO'd.
No. Yes. So they have to disclose their financials so for instance, when they're undergoing the pricing phase, and also when they're filing all the information to the SEC. So they have to then publish all their financials.
Okay.
So,
and then a follow-up, is it common for a company to IPO with poor financials in terms of negative cash flow and negative net income, or they're operating at a loss? Is it common for a company to IPO at that point?
well, to my knowledge, it's become more common from the last years in the tech sector. But I don't know, Rick or Jens, or do you have anything to comment on that?
So it's not uncommon for a company to go public when they have a negative free cash flow. But having a negative free cash flow doesn't mean that they aren't profitable. It simply means that they're consuming more cash as a function of growth than their profits can sustain, so they need to raise outside capital. It became relatively common for some of these high growth engines to go to the public markets even before having had positive operating income. But we pretty much pulled the sheets back on that in the dot-com bubble. And in fact, that really is what led to the extraordinary losses in that bubble. We've returned to some of that, but with maybe a little bit more sensibility. Jens, any additional comment there?
No, that was a good summary. Maybe I would add that just like Rick said, it's common to raise capital in the public markets with negative free cash flow or negative earnings, but you will need to present a good plan to get to positive earnings, because that's what the investors are buying into. Institutional investors are very concerned when it comes to margins and cash flows, because they need to get a return on their position. And that has to be cash flows. So if the company is not able to deliver, as we saw, some of you saw that in Open Table, the stock is going to decline and it's going to be harder for them to raise capital in the public markets in a secondary offering later. And also to just add to I believe it was Dylan asking this question, if you can see any filings. These filings are called S1, and you can go in and read WeWork's S1, and that's actually a fun read because they're trying to position what I think was a commercial or is a commercial real estate company as a technology business. And they had a lot of issues with that. They couldn't get investors on board while they were framing that story. And as of this morning, I heard on the radio that the company is worth around 2.5 billion, down from 47 that they wanted to do the IPO on. So pretty drastic reduction in value. And then if you want to read about SoftBank, who is this big, well, mobile operator in Japan that actually invested in WeWork, they're doing this big vision fund. That is an even more interesting read when it comes to what they call super venture capital. They lost quite a bit of money on this deal.